You want to pay tax on the stock when the value is low before its value grows. What is one common tax mistake that you see many founders make?
Yeah, that's a great question, Sam. There are many, but if I had to say one, I would say it's failing to make what's known as an 83B election with the Internal Revenue Service. I see that all the time. It comes up in my practice, if not every day, every other day,
Hmm.
certainly multiple times a week. And it can have serious ramifications. And I think that most folks who aren't in this space or in the tax space probably don't even know what that means, what the election is. And even if you have heard of it, how does it apply and what does it actually do?
So tell us, if I'm a founder and I choose to make this election, what does that mean for me?
Yeah, sure. So it's sort of commonly known as the startup election for startup stock. Essentially, you have someone who forms a company. The company at its inception is not worth a lot or as much as you hope that it's going to be worth years later when you go to exit. You're issuing stock in that business to people who are going to be essentially working for the company in order to get that stock. Essentially, it's a trade-off. You're going to be performing services, but we're going to issue you stock that doesn't have a high value because we're just starting out. But the goal is that it will have a high value one day. That's what the 83B election is essentially going to do. It's basically going to allow you to tell the IRS, I am getting this stock that does not have a high value now. Let's just say, for example, all the stock I get is worth $1. I'm going to tell you that, Uncle Sam, and pay the tax on $1. And hopefully, years from now, after I'm done getting all of my stock, commonly on something that's known as a vesting schedule, getting stock over a period of time, I don't have to declare as taxable income the higher value in that stock later on. So I'm essentially fronting a low tax burden now and not having to deal with a much higher tax burden when that stock blows up and becomes worth a lot 3, 4 years from now.
Yes, yes, absolutely. So this is one key concept, which I think was something you alluded to, is that the IRS, and we're talking about U.S. tax situations here, okay, not international tax, but in the U.S., the IRS, the taxing authority here, they want to tax you when you receive something of value. General principle to be correct?
Yes, you are correct, and it's also potentially a lot worse than that, but you are right.
Okay, great. So this 83B election, um, if you're a founder, let's say I get 1 million shares as a founder on day one, and then 1 year later, 25% of that vests or my repurchase rights lapse, okay, or the company's repurchase rights lapse, which is like vesting. Now I have 250,000 shares. When on day one, when I first got the 1 million shares, let's say I bought it at what's the standard price? A hundredth of a penny, thousandth of a penny, somewhere in that range.
Yeah, yeah, no,
So for
that's
1 million shares,
understand.
if I buy it for a hundredth of a penny, I'll pay $100. Okay, for the stock that I just received. Mr. IRS government, please tax me on the that the value at $100. 1 year later, maybe the company's grown and the stock price goes up because we've gotten some outside investors. They're buying stock in the company, which drives the stock price up. If I haven't done the 83B election and paid the tax on the stock when it was low value, what might my tax burden look like? Obviously, you can't do exact numbers, but just rough
Sure.
estimates and walk us
Yeah,
through it.
if essentially the 83B was not made, when you get the 250,000 shares a year later, you're going to
And let's
have
say
to.
that the 250,000 is now worth $1 a share, so, or $250,000.
You read my mind exactly. It's
Okay.
going to be a dollar share, 250,000. I need to tell the government on my tax return that is how much money I got when the 250,000 shares vested. So $250,000 and pay tax to the government on the $250,000. Um, Needless to say, I certainly would rather pay tax on $1 then 250,000. Everyone's tax rates fluctuate, but if you're somewhere in the ballpark of 20 to 30% tax, that's a lot of cash that you're going to have to come up with to satisfy the government's taste for the tax on
Right.
that $250,000 stock.
So basically, it could be a $50,000 to $75,000 tax burden that the founder has to pay.
Yeah, just to the federal government, and of course, depending on what state you live in, if you're in the U.S., that's an aside. But you're right. To the federal government, you'll have to come up with 50, 70,000, potentially even more.
Yes.
But it's quite steep if you do
Yeah.
not make that election initially. Yes.
Absolutely. And I've seen founders who've been in this situation where they're like, what? I owe tax, but they didn't actually get any additional cash to pay for it because they have stock. That doesn't mean they have the stock's not, the company's not IPO'd yet, okay, or the company hasn't been acquired yet. So what ends up happening is that they may realize they have a tax burden and they have no income, no cash income to pay for that tax burden. They've got to pay it from savings. They've got to negotiate with the IRS. They don't pay it at all.
Believe it or not, it happens. Some people don't pay it at all. So you're right. You have to either come up with the cash somehow. You can't dispose of the stock, savings, separate retirement, whatever it is, or you don't pay a part of it, or you don't pay all of it, and then you have a tax debt with the government, which is also no fun and isn't something we should be striving to have, although it does happen from time to time.
Yeah, and that's where the 20% penalties and interest and all that stuff start to come in, and your tax burden just grows and grows and grows.
It grows exponentially, and it can grow for many years. And the IRS, as a debt collector, they can come and collect that debt by freezing bank accounts, assets, things like that. So it can have some serious ramifications to actually have a tax debt with the government.
Got it. Got it. And are there any time limits on this 83B election?
Yeah, that's a great question. They're pretty strict. You've got 30 days from the date of grant. So using our example, you're getting a grant of stock, $1 million, and it's going to vest 250,000 each year over the next 4 years, just as an example. I have 30 days from when I sign all the paperwork and get my grant to make that stock, not 30 days from when it's going to vest or something like that. So it's really time sensitive. Candidly, if you blow the 30-day deadline, you can petition the IRS to sort of go back and basically correct the mistake on their end. Good luck getting that, though. It's really tough to sort of retroactively correct that error. So 30 days is the time limit from the date of grant.
Definitely pay attention to this 83B and such.
Yes,
Don't want to miss it. It can be very painful. All right.
absolutely.
So if I had to summarize right there, one of the key issues, don't fail to make your 83B election. You want to pay tax on the stock when the value is low before its value grows.